assuming you can just see my face right now. Thank you all for logging in for our first, I think this is the OCA's first Zoom virtual happy hour. We did a Q&A live stream in March, which feels like a very long time ago now. But I'm really glad that some of y'all logged on for this discussion. The best way to communicate with us during the discussion is the chat box there. You should see the chat feature in your toolbar. So we're here, we can chat with you that way. There's also a Q&A feature, so if you have a specific question you want to put in there, I'll be moderating that, and I'll let Kevin know as we go along. And then there's also the raise the hand function. So if you wanted one more option to communicate with us, you can raise your hand, and we'll do our best if you do that to put you on and let you on the audio and let you chat. But I will say that's probably about like a 75% chance of that working, but we're welcome to, we're down to try it out. So again, I'm Kim. I'm the executive director of the Oregon Cannabis Association. This happy hour, I have been talking to Kevin for a while about the work that he does and about specifically 280E and taxes. This is something that comes up, the last time that we were in DC with our lobbying work, and it just kind of, unfortunately, an unfair treatment for cannabis businesses, but it's the law that we have to follow. And so I'm really thankful for folks like Kevin that can help walk us through the process, both for best practices, for what, from a legal perspective, and then help you protect yourselves personally. Yeah. So yeah, before we get into it, I could think just a quick update on what the OCA has been doing. We've been doing a lot of work. First, it was focused on keeping folks open. And now it's, and then it went quickly into, okay, we're allowed to stay open. What can we do to help out with rules to help us stay safe during this time? And I think we made some big strides with that, but it's always an ever evolving process. So if you have things that come to mind that would help with rule changes, there's two things we're looking at right now. So if there's anything with the OLCC that you believe would help your business operate more safely, please feel free to reach out to me. I'll put my email in the box. And then looking forward to the governor's anticipated at some time, maybe in the next 2 months, when she calls a special session, we've been advised that we should focus on legislative rule changes that could help out the industry. So those are things that can't be changed on the OLCC rules level, but bigger changes. And then we've been advised that that would be a good time, that the legislature would be warm and receptive to trying to help us out. So what we're doing now is trying to craft those arguments and be ready to go whenever she does call that session. So I put a call out in our last newsletter for ideas around that as we craft those arguments. Again, feel free to reach out to us. Yeah, and I think Kevin and I chatted about that a little bit. So I'm going to go ahead and something's funky with the video if you're just logging on. So I'm going to go ahead and make Kevin the host, which should bring up his video and might kick me off. Oh, there's Kevin. Oh, look, there we are.
Hello.
Awesome. Hey, Kevin, how's it going?
Pretty good. Hanging in there.
Great to see you.
My quarantine.
Yeah. Well, do you want to, before you take over and jump into the presentation, do you want to give us kind of an intro on who you are and what Akeen does?
Yeah, of course. So my name is Kevin Haller. I'm an Oregon and California CPA. Akeen is a cannabis consulting and accounting practice. We've been serving the industry for 5 years. And we're doing a lot to just help clients maneuver the compliance and regulations. We started in the space doing tax and audit work, and realized there's tremendous help on the cost accounting, capturing inventory costs, staying compliant. So we're creating new services to help businesses navigate the operations.
Awesome. And we had talked a little bit, I'm gonna kind of just put you on the spot and jump in, but when we talked in preparation for this meeting, you talked about some tax stuff that might be helpful for us to ask for in that state legislative session.
Well,
Good.
I mean, I'm a big proponent to, and I want to remind everyone that during the Great Depression, prohibition ended alcohol. And I don't compare alcohol with cannabis whatsoever. I think they're totally different. I don't believe in putting them together. But what's going on right now is a significant impact on our economy. And new industries will be birthed, and industries will collapse, and industries will have to pivot. I believe we need to push for rescheduling cannabis, because what we're going to go into at 280E, you'll see how these rules are horrendous. And, right now, the regulators hate this industry, to be blunt, right? They hate it because it's illegal. And it was the same with hemp. And when hemp got rescheduled, it was all of a sudden, hemp's no longer a bad guy. So I believe, we need to definitely push for that is ultimately. However, some short wins is just aid support during this time. You see some people talking about essential businesses, how cannabis was deemed that, and how, as a result they're able to stay open, and they're making money. But the fact is because of 280E and the regulations, the businesses are suffering, and now they're putting their consumers at risk, their employees at risk, and they've paid tremendous amount of money into the feds and states, and they're not getting support. So support needs to be demanded. The regulators are benefiting from this industry being open, and it could benefit so much more, as you'll see in the presentation, if it was legalized, because it's a huge industry. It's going nowhere. And we need to embrace the changes that are coming, because this is a big deal on a global level.
Yeah, yeah. I'm glad you brought up the federal side. That remind me, we have a lobbyist that we work with in DC, and we just recently signed on with a coalition of 24 state cannabis trade associations to try to push both for aid, but then with the power of that letter that we put out, now we're pushing for the Safe Banking Act. Of course, it's everyone like schedulization is the top priority, but our political pros right now are saying on the Senate side there just isn't isn't any appetite for anything that has the word cannabis in it. So we're trying, at least with the aid, to be a little clever in how we craft things, and using words like essential businesses that were allowed to stay open, because in Oregon that's actually our classification, to push for things like aid and banking on that level. And then, but of course, eye on the prize. We know what we want.
It has to happen. I mean, right now it's like it's a huge industry, and I have some information that I've gathered on what it is, and there's a lot more money to be made at the regulator side if they did open it up.
Sure.
And banking is absolutely crucial, and without banking, what our IRS focus is going to be on, it's not following the money, because without banking you can't trace it. It's compliance with 280E. And so it's a double-edged sword. And then now when we're trying to keep social distance and not touching, the fact that you can't auto pay and you have to hand cash, it's so archaic.
Yeah. Yeah.
It's not necessary. And we just need to continue to push and show the country how important this industry is, because there's the direct cannabis businesses, there's indirect, and so many people benefit. The economy benefits, and so we'll get into all that. But yeah, and the whole point of the CARES Act is to provide benefit to businesses and individuals. And this industry employs 250,000 people.
Mm-hmm.
And so we need to make sure we're taking care of businesses, even if they feel like, we don't support it because you're illegal. The fact remains is that the government is the most material cannabis benefactor than anyone, right? So if in the SBA, they defined indirect marijuana businesses as unable to obtain support, yet the feds received $4.7 billion in 2017 from this. So no one profits more from cannabis than the federal government.
Yeah. We all want to stay open. Cool. Well, I think from that we can just go ahead and jump right into it. Again, to those of you that are watching, thank you, welcome. And if you have questions, I think that chat box right there is probably the easiest way to do it. But if you could also use that fancy Q&A button there in your toolbar, and I'll be moderating that, and we can jump in Kevin's given me permission to interrupt him at any time. So if it's a time-sensitive question, just go ahead and put it in there, and we will we'll take it from there. All right.
All right. Let me see what just happened here. Is everyone seeing my screen here?
Yeah.
You see it? Okay, perfect. Now we need to come over here. We're going to do the slideshow. And we are going to display it as such. So the topic tonight is 280E and are you audit ready? And this is in response to ultimately the Treasury report that recently came out that was very critical of 280E in their sample testing, which I'll have slides on and be going through with everyone. Here's a slide on me. This is, I'm Kevin Haller. I'm a principal at Akeen Consulting. And as I said before, we've been serving the cannabis industry for 5 years. And, we're really excited about the industry. On a personal note, I've been passionate about this industry for 26 years. So my intentions are to, help shape a meaningful industry that is thriving. And that's what I really want to come out of all my work that I'm doing with the businesses that we serve. So some of the learning objectives for tonight is I'm going to give a quick recap of the cannabis industry. I'll go through what is IRC 280E and 471. How does 280E and 471 impact cannabis businesses? Why entity structure matters. I'm going to go through a recap of the Treasury report, and then I'm going to come up with some risk management and best practices for the industry. We don't have tremendous amount of time to dive deep, so I'll try to kind of go through enough to give some information. And I want to make sure I save time to go through, what should businesses do, because that's the really meaningful part. And, my information you can get from Kim. You can always reach out. I want to be a resource to anyone who has questions. So first off, here's some industry statistics. Now this map was taken from legal states as of July 2019. This is always changing. The top part is, cannabis is a federally illegal drug. It's a Schedule I controlled substance. And as a result of that, Section 280E applies and 471. Roughly, 66% of the states in this country have legalized cannabis in one way or another. And legal cannabis industry sales are increasing, 11 billion, 13 billion, projections to 25 billion. Now, a lot of the legal cannabis industry growth is mostly due to states passing legal laws, which allows these businesses to operate. And they're ultimately taking consumers that were previously supporting the illicit market. And new consumers are coming on with new product development and such, but for the most part, this industry's been around for decades. And a lot of the consumers have been around since before what's going on today with legalization. And so that's really, where a lot of this income is coming from an existing market. Now, the illicit operators, they don't have to deal with the tax structure that legal operators have with federal taxes, state taxes, excise taxes, sales taxes. There's just several taxes along the way, and then the cost of being compliant. Illicit operators don't have to deal with that, don't have to deal with accountants and lawyers, don't have to track anything, so they can really price product very, very fair for consumers, which makes it very hard for the legal cannabis to operate. There's a limited number of dispensaries, again, across the country in many jurisdictions, not Portland per se. And then, the consumer has a historic relationship with the illicit market. And then there's unreliable data. We don't really know how big the illicit market is, but according to New Frontier, currently the illicit market in this country alone is $70 billion. So I would say that the tax structure is very short-sighted, and it's almost like chasing dollars. And I believe if it was opened up, they could print Benjamins, because $70 billion compared to $13 billion is nothing, right? I mean, we're talking about a very material industry that needs recognition in this country, and that's just directly related. We can't quite quantify all the other businesses that benefit from this industry as well. So the big question, and I'm sure most of you, if you're operators, know, is what is 280E and 471? Everyone has a pretty hopefully good understanding of it. But ultimately, 280E prohibits the deduction of any business expenses. Cost of goods sold is not considered a deduction. It's ultimately a reduction in gross income. And that's an important part. And then there's IRC 61, which ultimately defines how, basically it says that just like when you sell a property, gains derived from dealings in property. So if I had an asset and I sold it, the cost of my asset is deducted to come up with what is my income on it. That's how IRC 280E is intended. And I'll read a direct blurb. It's no deductions or credits shall be allowed for any amount paid or incurred during the taxable year in carrying on any trade or business in such trade or business is in consisting of trafficking a controlled substance, which is prohibited under federal law. So it's very harsh. And we'll get into how harsh it is depending on where you're at within the supply chain. And the Internal Revenue Code has provided very little guidance other than court cases, which determine precedents, and also the Office of Chief Counsel Advice, there's the number, it has determined, it defines what cost of goods sold is under 471. So there's been various court cases like Payton versus Commissioner, Franklin, McCann, but ultimately, marijuana businesses can only deduct their cost of goods sold. A lot of the rules come out, that people have tried to take 263A when determining cost of goods sold, and ultimately court cases have said, no, that absolutely doesn't work, because ultimately 263A came after 280E was already in place. So there's been many court cases that say, no, 263A is out. So IRC 471, which basically defines what can be considered cost of goods sold. It's ultimately saying you need to reflect inventory, and there's two valuation methods, and one is the best accounting practices in your trade or business, and it has to clearly reflect income. Again, that's an important piece. You have to be consistent year over year, and the basis in terms of how you determine your cost of goods sold has to be in line with 471-1 through 471-11. And we'll get into 471C, which a lot of people believe like, oh, this is my loophole, my out. There are no loopholes. There are no outs. And you got to have deep pockets if you're going to try to establish precedents. But it's something that I wouldn't recommend unless you're willing to pay attorneys a lot of money and drag things out and really go head to head with the courts on this. So really, they break it down into two different buckets, right? You have retailers and you have producers. If you're a retailer, all you can deduct is the cost of the cannabis you've purchased and the transportation and necessary charges in acquiring the cannabis. That's acquiring, not moving it somewhere else. So you have very little deductions. So think about it, in your retail store, your building, your lease, not deductible. Your bud tenders, not deductible. Your showcases, not deductible. Nothing that you do, if you're delivering your drivers, your cars, none of that is deductible for you. Those are all added back to arrive at your federal taxable income. So retailers and distribution, this rule is incredibly harsh, and it makes it very challenging to stay afloat. And what it does take to stay afloat is having very, very clear processes and mechanisms in place to capture information to make smart business decisions. When it comes to producers, you have a little more leeway with direct costs and certain indirect costs. So from what I've seen, the businesses that are able to successfully operate in this industry are vertically integrated, or at the early start of the supply chain, like a producer or manufacturer. And we'll get into some of those things a little bit later in terms of why I think vertical integration is the number one way to navigate under 280E. So here's business deductions not allowed, and I said some, but marketing, advertising, selling, distribution, interest expense, if you could get a loan, most of that's related parties, but none of that's deductible. R&D, depreciation for tax purposes, so accelerated depreciation, bonus depreciation, which are allowed for normal businesses, are not allowed for cannabis businesses. Income taxes, pensions, general administrative expenses, officer salary, unless they are directly related to production activities, which it's very hard to make that justification, and you'll have to make sure you have support if you're going to make such claims. Now, I know this one's a little bit challenging to see. This was a blurb I taken from an article, and it kind of showcases some of the costs. But ultimately, that first column, those are your inventory direct costs. And again, at the end of this, I'm going to give these slides to Kim, and she can share them. So you all have access to this and can use this as a resource. And again, can reach out to me. And I'm also going to give the Treasury report in case anyone hasn't seen that, but that'll be available for everyone as well. That second column is indirect costs that are allowed. Now that third column, those are some indirect costs that, you know, you're not required to capitalize under the regulations, but one could make the argument that you could. However, if 280E was lifted and you were including those, you would basically have to file a change in accounting methodology then if you wanted to convert over to 263A. So again, this is just kind of laying out what you can and can't do and might be able to do. That all the way to the right column is what you are not allowed to do. So now when we get into 471C, this was, you know, came out in the Tax Cuts and Jobs Act, and everyone thought it was this loophole that would allow small businesses to just say, well, every bit of my expense is considered cost of goods sold. I don't believe that this is a justifiable position, and I'll go through some of the language as to why. Basically, it's intended for small businesses to not incur the burden and cost of tracking inventory. However, this industry, you're forced to track inventory from seed to sale. So right off the bat, the fact that this is intended, this rule 471C was to just basically say you don't need to track inventory because we know it's burdensome. We're required to. You can't just call everything cost of goods sold because 471 clearly defines cost of goods sold, and 280E clearly defines you're not allowed to deduct anything except cost of goods sold. So ultimately, there's this circular reference kind of thing going on where 471 kind of threw out something that people are trying to reach and trying to be creative. All I'll say is that is a very difficult position to justify, and you run certain risks if you were going to take such a position. In the Treasury report, there were 6 findings. I'm not going to go over those 6 findings because they're not really the reason why I wanted to show the Treasury report findings. But the one finding in which the IRS refused to comment on was the Treasury report asked for guidance on 471C. And I thought it was kind of funny that the IRS said, no, we're not going to do that at this time. We got too much other stuff. It'd be very easy for them to say, no, they left it open. And that's going to be a difficult position for a lot if they take that. Now, me as a CPA, I would not sign a return of anyone taking that position. There are accountants out there that will. I don't believe it's defendable at all. There's a lot of accountants out there that, you know, they're making money off of clients, and, you know, it doesn't really matter what happens to you down the road. Again, like I said, my passion is this industry. I don't believe that's going to be doing anyone any favors. You know, I sometimes associate my guidance that of, like, you know, I'm also a parent. I have 2 little kids. My daughter, Nora, would love to eat nothing but cookies all day long. And I would be doing her a disservice if I enabled that behavior. And sometimes as, you know, a parent and as a professional service provider, I owe it to my daughter and my clients to be like, no, you can't do that. As much as I hate this rule and I would love to help you, this is the industry we're in at this time, and this is the rule, and you got to navigate the rule. You're in this business for one of 2 reasons. You're going to operate a business and because you're passionate about this industry and you want to build a business in this industry, or there's a lot of people that, like the green rush of its time, are coming in to make money and leave. But just like the gold rush back when it happened, most people died on the way there. And just like this, right now, a lot of businesses have already been cannibalized, and many, many more will be, until we can kind of get rules in place that allow this industry to really thrive. So the potential impact of 471C is there's a rule in 471 that basically says, you know, inventory as non-incidental materials and supplies. If you were to take a very strict position, like saying every one of my costs is considered cost of goods sold, right? Because why? Well, because then I get to deduct it. That's the only thing you could really argue. But are these costs really cost of goods sold? And if you took the position that all of my costs are cost of goods sold and you went to court trying to defend that position, you could run the risk of them saying none of it's cost of goods sold. And you blatantly crossed the line in a rule of 280E and 471, therefore we're going to disallow all your deductions. I don't know whether or not they'll do that. That's just the risk you run if you're going to try to take this defendable position. The taxpayer method of accounting under cost of goods sold. Does 471C follow 280E or even definitions of inventory of 471? The answer to both those is no. They absolutely don't. And the fact that the IRS hasn't provided guidance, it doesn't confirm with industry best practice, because 471C is ultimately intended for businesses that have less than 25 million in gross receipts for 3 years. The industry has to follow 280, and a lot of those big operators do. So you as a small operator couldn't say that this is in conformance with industry best practices, because industry best practices are you got to follow 280 and 471. And like I said, it's a very aggressive inventory classification that violates 471. The fact that the law is uncertain, and you would be unable to obtain GAAP financials. So right now too, if you're bleeding out because 280 is burdensome and you need outside investor capital, you can't get GAAP audits if you're saying everything's cost of goods sold, because that violates GAAP too. So you have to be very thoughtful in all the positions you're going to take, and you got to make sure that they're in line with your future goals and where you want to take this business anyways. What's going to happen in this industry is ultimately right now, a lot of the big players are getting a lot of traction. There's going to be a lot of mergers and acquisitions. There's going to be craft businesses probably under larger umbrellas. To get under one of those larger umbrellas, there's going to be due diligence, the needs for audits. And then there's going to be a lot of businesses that, don't get certain things and are going to be kind of blown out. The other thing I want to bring up is what's going on in the world today. We've been on the brink of an automation revolution, right? And right now, when there's social distancing issues going on, this is going to propel that forward. And so when we get into later, some things to focus on, it's like you need to get processes in place that are sustainable and be forward thinking as to where you want to go. And a lot of automation and things are already in the works in this industry. And you need to be looking at those kinds of things, because that's the world we're in these days. So how does 280E impact cannabis businesses? Well, it's a killer. It's incredibly challenging at the retail and distribution level, right? If you are a producer and your facility is completely dedicated to production, you're able to deduct a lot of your costs. Granted, your general administrative, accounting, legal functions, there's a lot you don't. So it's even very harsh on producers. But back to that previous slide, if you are a retail, all you can deduct is the cannabis you bought. And you can't even come up with crazy ways of having another related party that's going to oversell it to move it. We're going to go through, because court cases have unwound those related party complex structures to do such that, and you have to treat everything like an arm's length transaction, and they'll use the market rate for going for it. So pretty much all you can deduct is the cost that you bought product. That makes it very hard for you to compete with the illicit market, right? The illicit market has set price expectations. And when you're layering on all the tax, the facts that you can't deduct any business expenses, that price of that cannabis keeps hiking up higher and higher. And consumers at some point are, not going to pay in many cases, because they have the relationships with the others. So it makes it very hard for these businesses to survive. It forces a lot of people to take aggressive tax positions, because they're like, well, I can't do it otherwise. Well, know that you're just basically delaying the inevitable, right? Only there's going to be interest and penalties. But then you're like, well, do I either give away capital to someone else who might, direct my business or make unfair investor terms? Or do I take aggressive positions knowing that one day I'm going to be paying it? And it makes less capital to reinvest into your business. People have tried creative workarounds. So everyone's throwing their money at how do I circumvent 280E, which I think is a very wrong focus for a business operator to have. I would never focus on the cost of doing business. There's other things to focus on, which I'll share. And in many cases, it results in an effective federal tax rate of 80% of gross revenue. And here's an example. This was a straight hypothetical from the Treasury report. You have gross income, let's say, of $500,000, your cost of goods sold. You have other business expenses. Your net income is $100,000. You add back all your IRC 280E adjustments, and your taxable income is really $250,000. You paid $80,000 on $100,000. That's your 80% right there. Harborside. Hopefully many of you have heard of them. It's a California-based company. Harborside case, what was the outcome is even Harborside, they were determined to not be a producer, rather a reseller, because Harborside ultimately, even though they had control of the inventory, they outsourced a lot of that function to other growers. They dictated the terms, they dictated everything, and then the court was harsh and said, no, you're not a producer, you're a retailer. They basically said, nope, 263A does not apply. You're a drug trafficker. 471 is how you value inventory. So that court case already said 471 how you value inventory. They had a $36 million judgment against them, and they got it reduced to $11 million, and they considered it a victory. And that would be a huge victory to me. I'd much rather pay $11 million than $36 million. And ultimately, $6 million of that was penalties, and they waived them because Harborside acted in good faith. And what that means is Harborside spent a lot of money, and they dialed in all of their internal controls process. They tried to, showcase why they were able to take those positions. So if you are going to take an aggressive position, the one thing I'd say is you better make sure you are documenting it and pulling everything in. The hard thing is now that we have court cases with precedents, it's hard to kind of go against what they've already established in the courts. So someone's going to go head to head with them with 471C. I wouldn't recommend it unless you're ready to fork over a lot of money to attorneys to defend, and you've set aside the money to pay that tax bill when it eventually comes. Another case is the alternative healthcare. This collapsed those complex structures. So when you saw someone basically to try to circumvent 280E, they basically created their management company, their payroll company, and they tried to offload a lot of those expenses. And they also lacked sufficient records, which was very hard for them. So, record keeping is incredibly critical. They had non-marijuana products, but those were incidental to their primary business, because a lot of people tried to, we also sell this. So, and ultimately, all these court cases, they basically said deductions are a matter of legislative grace, and it's the taxpayer must prove it is entitled to deductions. However, the rules are very strict on what is considered a deduction and what is not. Why entity structure matters. This could be a big deal, right? Because you're dealing in something that's federally illegal. And ultimately, if you are a flow-through entity, that means you yourself as the individual are subject to 280E. So if you're an LLC or a partnership, you get a K1, that flows through to you. And you're personally tied to it. If you've been taking aggressive tax positions for many years and you basically have 5 years worth of audits coming down the pipeline at some of the dollar values that I'll show you in future slides, that could not only put your business out, but it could put you personally out. Corporations now under the Job Tax Cut Act have a flat rate of 21% versus some individuals have the max rate of 37%. You're also, in California, I know this doesn't apply to a lot of organ operators, but in California, corporations are not subject to 280E. However, a cannabis LLC would be subject to 280E in the individual. So in California in particular, and for overall risk assessment, I would always recommend a C corporation for liability purposes in this industry, and I would not recommend anything else. I know that there was a lot of attorneys and people that would say, it's cheaper to do a flow through. Again, I think we need to be thinking about the bigger picture and risk management And I think that every business operator is going to have to assess that and make the decision based on what they feel is best for them. But I just want to point it out there that me as a professional, I would never be anything other than a C Corp in a plant touching entity. Now to the Treasury report. I don't know if any of you saw this. This was, we all knew this was coming, or at least I knew that this was going to come. It was crazy to kind of see this. The focus was just California, Washington, and Oregon at this time, right? They were looking at 2016. You can see the active licenses, the sample size, and adjusted population. Now, there's a lot of numbers because that we'll go through. Some of those are on the sample, some of those are on the adjusted population, but we'll kind of go through some of those. Here's what the focus was. Ultimately, in 2016, 59% of tax returns were out of compliance with what will be 280E adjustments, to the tune of $48 million in assessed taxes just on the sample, right? So just on the business's sample, which that was 140 out of 237 returns. That's a big number. 95 million in unassessed taxes on the entire sample population, and that is the when they projected out to the 237. So 48 million out of 140 tax returns, 95 million on 237 tax returns. This slide just was more so to show, and this is in the Treasury report, the dollars per hour. Now, what a CIP is a compliance initiative program, which some states have adopted and left. And then there's the non-compliance initiative program. And then DIF is a discriminant factor. So that's kind of like the general pool. And what's important to see here is that look at the amount of dollars per tax returns that could result in an examination, and how much dollars an IRS agent could earn per hour examining cannabis tax returns. The focus is going to be heavy on cannabis tax returns looking at this, because the government is like any other business, and now that they're shelling out trillions of dollars, once they get capacity again, they're going to want to focus on recuperating as much money as they can. So just know 2021, 2022, because again, this report came out in 2016. The IRS, or in this Treasury report, they're doing a 5-year look. 5 years from 2016 is 2021. So when they come and audit you, they're going to want to, in one swoop, tackle 5 years at a time. And because then, so this will all accumulate over that. So this is going to happen in the next year or two. And even if cannabis becomes legal, when it was illegal during these times, this will still apply back then. It's not like all of a sudden, if it's legal, this was like, oh, it was fine, it was illegal then. And unless they make rules saying, oh, forget about it, which I doubt they will, this is what applies. So California, there was 38 returns that had likely assessments of 49 returns. That was to the tune of $5 million. It's an average of $100,000 per return. When they projected it to the entire state, 260 had likely assessments. And again, there's a complex structure in how they kind of determine this, but ultimately that was a $35 million impact to California operators. And the average business in the sample was 2.6 million of gross receipts. Washington, 59% of errors, $1 million in likely tax assessments, $12,000 per return, $7.8 million impact. The average business size was $1.2 million. Our state, Oregon, 49 of 98, half the returns, $1.1 million likely assessment, an average of $11,000 to $12,000 per return for just 2016. And that's just on what they likely saw, right? They haven't even dug deep. This is just the blatant errors on the face of the tax return. And I can tell you as a tax preparer, I've seen some returns where a distributor would show me almost $5 million every dollar they classified as cost of goods sold. And I just shook my head. It's like, I don't know what to tell you. Like that's a tough position to take. And it's those things that they saw that it's just a blatant error. So this is where it kind of drills down a little bit further. So in California, roughly this $16 million is made up of, and that's this over here, if you can kind of see it, and we'll walk through this. Basically, this adjustments for business expenses, $15 million, $15.6 million of that $16.7 million was for aggressive positions, taking deductions for business expenses, right? You can only deduct cost of goods sold. So there was blatant crossing what they were categorizing as cost of goods sold. Of that 16.7 million for California, almost 600,000 was related to accelerated depreciation, which again, I said accelerated depreciation is not allowed. So you were not allowed to take bonus depreciation, 179, or any other form of accelerated depreciation. And about $500,000 of that relates to 263A, where businesses took the position of 263A. So the three major buckets are classifying cost of goods sold when they shouldn't have been, using 263A, and taking accelerated depreciation is what made up that potential expense adjustment of $16 million. Oregon, it was $3.7 million related to aggressive positions, 1 million on 263A, and almost 500,000 on accelerated depreciation. So if you were in business in 2016, if I were you, I would look at my tax returns. I would start looking at future tax returns, and I would start quantifying what my potential risk of exposure is here, just to not be blindsided by it. Just know that you will be audited if you are in this industry. My prediction is if you aren't already under audit, it will be in the next probably in 2022, and you want to be ready for it so you're not completely blindsided by it. Now, what this is showing is a 5-year forecast, just to walk through it, is that 2.4 or 242 million is what they're forecasting on this sample over 5 years. And that's a very, very significant number. Since this is a cash intensive business, this is what the Treasury report said, that there's unique tax compliance risk in cannabis due to 280E and the fact that it's very cash intensive, right? If there was traditional banking, audits could focus on revenue and following the revenue, but in a cash intensive business, they really can't. California, Oregon, and Washington had a high rate of non-compliance with 280E. IRS agreed with 5 of the 6 recommendations. And again, I'm not going to go into those because I just wanted to showcase the numbers. Again, if anyone wants, we can always talk about some of those, or you can read the report. But the one they didn't agree with was they refused to provide guidance on 471C. And that's that loophole that some people are trying to aggressively take. And the IRS is they stated they're going to use data analytics to identify non-compliance. So right now we live in a day and age where data and information can be easily sifted through. And right now they've just been gathering information, right? It's been years. They've seen now several years of tax returns. They've seen tax returns and they're developing expectations. They see the ones they believe they're doing right, and they can easily compare them and see the ones that they think are not. Now this slide shows another one. Now the last one was based on the population. This is them extrapolating it based on this number here, the projected exception. So of 1,070 returns, 5-year forecast, those individuals will have to shell out an additional almost $500 million. That is crazy, right? And so what the Treasury inspector did is they obtained a list that was basically 4,000 returns with potential marijuana business activity in 2016. And of that, they just took a sample of 237 to compute a lot of this. The total expense adjustment for 169 returns is the 53 million. So that 53 million is just on the 169 returns. Oregon, basically what this is showing is in 2016, of that entire sample, every person is going to basically pay almost $30,000 of additional taxes for 2016. That's what this number down here is telling you, that tax impact. Here's the impact at the global level, and that's your 5-year forecast. So knowing all of this and that this is going to be coming, it's kind of like, well, what do you do now, right? And that's the important thing, and what should be done. So internal controls, right? You are a business like any other. What is most important is having controls, processes, whether that is accounting. Like, I believe information, numbers are everything, right? The numbers tell a story. The numbers allow you to make smart business decisions. If you have reliable numbers, you can assess those numbers, make business decisions, pivot. Like I said, we are on the brink of an automation revolution, and information technology is critical. Businesses with good information, now there's tools for forecasting, right? Making pivots real time, understanding, but you got to have internal controls. Now this cube over here, this is from the COSO framework for how businesses should establish their framework for internal controls. As you can see, there's operation, there's financial reporting, and there's compliance at the top. And then you have your 5 major categories. You have your control environment, your risk assessment, your control activities, information, communication, and monitoring. Everything needs to be laid out in processes. If you ever hear me talk, I'm always big on processes. Processes are everything. Processes help you support positions taken, right? It forces you to go through and formulate your processes for operation. If you're a cultivator, what are all the processes that you have to go through for everything for cultivation? If you have to monitor the seed to sale, you need processes in place for doing that. Financial reporting, you need to know what it costs. If you can't tell me what it costs you to produce a pound of flour and what it costs you to produce a pound of shake by strain, you don't have a handle around your business, right? You don't know whether or not making a pivot is the right decision. Businesses need to be focusing on, how do I maximize my, if you're in production, maximize my yield with the space that I have. That's what should you focus on? What is your grow plan? Are you taking advantage of technology in HVAC system? Are you dialing in what that HVAC should be for that particular strain to maximize its output? I've seen many of operators growing so many different strains, and here they are throwing money at, how do I circumvent 280E, when I say, if you just changed what you're doing in the same amount of space, you could probably grow your top line by hundreds of thousands of dollars, if not more, depending on the size of your business. If you have processes and you're capturing costs, you know how to manage those costs and how to pivot. So instead of a focus on 280E and how do I circumvent 280E, your focus should be on, 280E exists. What should my processes be to ensure my business can operate under such harsh conditions? And so internal controls is the key. And then grow the top line. Like I said, rather than focus on 280E, figure out, if you're a business and you're a cultivator and you're making $500,000 a year, how do you get to that 800,000 in that same space? That's maximizing your yield in your space and having a faster turnaround. The key to a successful business, and that's why, again, vertical integration is key. If you're a cultivator and you're growing product, a lot of that product is sold via wholesale. Why vertical integration, I'd say, is the key to a successful business at this time is because if I can cultivate and manufacture my products, and then I can push my products through my retail channels where I can break them up into eighths, quarters, ounces, and sell that to the consumer, you're going to make a lot more money than selling those pounds wholesale. And you will be able to take advantage of deductions under one business unit, where the other one, the retail side, it's very harsh and strict, and you will not be able to take advantage of those. However, chart of accounts, even if you are vertically integrated, you need to bifurcate and separate both, because when the audit comes, if you are in the business of doing both, you need to say, here's my inventory valuation for my production side. Here is mine for my retail side. Here's how this one supports these chart of accounts. Here's how this one supports this in my chart of accounts. And drill down further. Here's the job description that says that the owner of the business spends this much time on production so that I can allocate that to cost of goods sold. here's the time studies and how frequently we do them to support what is in that job description, right? So you need to document everything all the way down to the nitty gritty. And every business should do that. And if you have those processes and that documentation in place, you can assess that and make decisions real time. So clearly defined processes, hire the right people, right? And then through processes, if you have a top performer, and most people in cannabis, I know they have these great employees and they are worked to death, or it's the business owner themselves working to death. If you put all that down in processes and have a process-focused organization, you can train and push work down to people if you're focusing on those processes, i.e. giving you more time and pushing work down to others so you can be more strategic in how you do things. I've seen so many times where people that should be making strategic decisions are bogged down into capturing basic cost accounting to try to get their hands around what it costs them, what they produce. Processes will allow that. Processes will allow you to train people. Adopt the right tools and technology. Right now in cannabis, because it's a new industry, there's a lot of technology that is lacking, and more times technology solutions are coming into place. So you need to be monitoring that. You need to be staying on top of what are the tools out there. How can I have a tool that helps me calculate my cost of goods sold without relying on a spreadsheet? And how can I then make sure my marketing or sales team understands, and how does this interplay with this? All these different technologies, you need a way to get your hands around all of them. How do they all work? How do they all interact? That's an important component of your business. Having an electronic accounting system. Now, one of the risks with QuickBooks, especially one of their modules, is QuickBooks is big into IRS forms, so they don't support cannabis businesses. And you run the risk, if you're using QuickBooks, of them shutting you down. So what's your backup and storage system, right? And QuickBooks, in my opinion, is good for some small businesses, but if you're on the production side, QuickBooks doesn't really help you capture information that's critical for you to determine cost of goods sold. So you probably need a more sophisticated accounting system. Accrual method of accounting, that's a little trick, right? If you are a cash basis taxpayer in cannabis, you're probably leaving money on the table. I would recommend you look at how you're filing, and I would always recommend being an accrual basis accounting a taxpayer at this time, because most of the time under in cash or in the sales in cannabis, cash is transferred at the point of sale, right? Very little times do we see that there's AR, not to say that there isn't, but very few times. Most of the time it's a point of sale. You give the cannabis, you get the cash. So there's not much of a difference in many cases from a revenue perspective. However, from the expense side of things, a lot of times you can accrue for certain expenses and create payables, whether you not paid them, and have that liability and take that deduction. So as a basic thing, that's some low-hanging fruit right there. Definitely make sure you're an accrual method of accounting. You need to actively monitor your balance sheet. And to do that, you need accurate accounting information. I can't tell you how many times we go in to assist with a tax return and there's so much cleanup and so many material adjustments that how does a business make sound decisions if there's so much disconnect between their numbers, right? You need to be able to capture accurate data real time so that you can make smart and strategic decisions. And that's so critical in an industry with such harsh rules like 280E, right? If you cannot deduct any expenses, you have to be so incredibly lean on your spend. And the only way to do that, again, is to have processes in place to capture the accounting and to make sure that you can then look at things. And then again, at the bottom, proper accounting under different licenses, because the rules are different for producers and retailers. And if you are vertically integrated, you need two different sets of policies, and you need to make sure your chart of accounts is there, because when you're under audit, you're going to want to say, here's my retail side. This is the cost of goods sold. Here's when we transferred stuff over. Here was the cost. Here's what we purchased. There's what went through there. Now on our producer side is this, because the last thing you want is, if you have poor accounting records, you didn't do a good faith in terms of, if you don't have good record keeping, they're not going to be likely to waive the penalties. And the last thing you want, if you are a producer, is for them to consider you retail because your accounting is, and your information is so poorly maintained. And, be prepared for the inevitable, right? The inspection is going to come. So for risk management, I would definitely say if you created a business with a complex structure to try to move expenses so that you could capitalize on 280E and circumvent, I should say, rather 280E, I would rethink that, because the court case definitely said all those entities that they created were subject to 280E. So they spent money, they're filing tax returns, they incurred legal costs to create this entity to do something that was not allowed, i.e. their focus was on how do I bifurcate or how do I circumvent 280E instead of how do I use what resources I have, knowing that this is the cost of doing business, to propel my business forward. And that's an important thing. Process focused. That allows you to train, develop people. It allows you to, if you build processes properly, by design, you could be compliant, you could capture pertinent financial information, and you could have very precise processes in how you do things in terms of operations. Your chart of accounts in accounting is so important. You know, so many times, and I understand when you're launching a business, there's so many things to use your resources on. And so many times I've seen business owners or people that do not hire a right accountant. They start off with having someone who shouldn't be doing accounting, maintaining their records. That you're going to have a very short-lived life in this industry if you're doing that. It's so important to make sure that whoever is maintaining your books has a solid understanding of 471 cost accounting, and that they are able to build a chart of accounts that supports that. So really how it is what I always recommend to clients is, you know, you have your chart of accounts, everything that you have coded as cost of goods sold, you need to support. So you need to have your inventory valuation memo that ties into 471, and I would use language for 471 and why certain things belong in those buckets. For those indirect allocations, have further drill down support as to why things belong in those buckets. And you just got to document. And I know every time you hear that, that's more and more cost. But again, as I said at the beginning, in the gold rush times, most of the people running to make money, people died on the way from the East Coast getting over here. People got over here, didn't make money, couldn't find any gold. It was horrible. And that's kind of what's going on right now. Everyone's scraping to try to build their empire, and everyone's trying to get into this game for various reasons, whether it's an investor trying to capitalize on the emerging market, or it's someone who's been passionate about this industry for a long time that just would love nothing more to make a living in this industry. Just know these rules are designed to be incredibly harsh. They're designed to hurt you. And until cannabis is rescheduled, if you violate these rules, you run a serious risk of having a material amount of money being assessed on you in the very near future. And so what you need to do is look at what is your entity structure. Are you a C Corp? If not, you need to really look at how do you change that. If it wasn't during those years, I mean, you as an individual are subject to 280E. If I was an operator, I would be doing a look back right now for every tax return I filed and positions I've taken to quantify what my risk of exposure is so that you're prepared for what might come. And if you haven't by now, start maintaining incredibly accurate accounting records supporting every purchase, every sale, every transaction, support allocations to your only saving grace, which is what is cost of goods sold, and be lean as possible on all other expenses, which I know if you're in retail, that's impossible. Right. And so again, these rules are designed to be incredibly harsh, and it's so unfortunate. And I would love nothing more than for all of us to unite our voice and push and share with the regulators. Look, if this is a $70 billion industry today, and our economy is such crisis right now, this industry could really help create jobs, bring money into this country. And, you know, really, this is on a global scale. The United States is in a unique position to be the leader in this industry, right? On a global scale. So that $70 billion is just from the new frontier, the illicit cannabis market. That's not even counting all the applications of hemp from an industrial aspect and from CBD extraction. And so we need to really push for that, because that's incredibly important. Honestly, this industry can't thrive until 280E is lifted, and the only way that happens is they're not going to lift 280E. Cannabis needs to be rescheduled. And so with that, I will leave it up if anyone has any questions. And again, I will make these slides available to everyone. Kim will shoot them out to everyone. I'll share the Treasury report. Here's my information. Again, it'll be on the slide. We are here to help. I'm not going to enable poor business decisions by letting any of my clients take positions that aren't defendable. What we do help with is how do we map processes? How do we help businesses set up that internal control, that foundation, the chart of accounts to be successful? And how do we have a top line focus on our growth plan, on our pricing strategies to be successful? And let's not focus on 280E, but let's understand it and maximize what we can account for as 280E, but let's not use 280E as our driver. And at Akeem Consulting, we're passionate about cannabis and we want to help. So we are a resource here for you. And thank you very much for all of you spending your evening with us, with the Oregon Cannabis Association, and with me to kind of share some of those insights. And I'm happy to drill down further with anyone at a future time if you have any particular questions about your particular situation.
Excellent. Thanks so much, Kevin. Can you hear me all right?
I can.
Cool. I think, I'm not sure if my video can come back on or not, but we'll just stare at my name while I'm talking. Wow, that was a lot. I feel like we all kind of need like a nice little, we should have ended with a picture of a unicorn or a nice kind of something happy and fluffy and comforting. But like someone just said, it is really great information, and it's important that we know these things now before it's too late. And it's good to know that there are some stuff that we can do. I do see one question in the Q&A box here.
I'll address that. So an S Corp is a flow-through entity, right?
And
so,
real quick, Kevin, I'm not sure if everyone can read it. So
yeah. The question is why a C Corp instead of an S Corp? Now, a C corporation, it files a tax return and it pays taxes, and normally the business owner gets a W-2 or it pays dividends. A C corporation has liability, and the buck stops at the C Corp, right? So if the C Corp was overly aggressive on 280E and it can't pay its tax bill when that comes, the C corporation can dissolve and pay the tax bill, and what's not left, it's the C Corp files for bankruptcy and it's done. If you're an S Corp, when you file your taxes, you get a K-1. You report that K-1 on your personal tax return. So when you file your 1040, you file your K-1 as a component of it. So why not a C Corp? Is because that liability flows through to you. You as the individual are subject to 280E. When the IRS audit happens, if your tax bill is in one of those slides, if $29,000 in Oregon times 5 on a 5-year period, saying an average, that's a big number, and you can't pay that. Not only does your business get annihilated, but whatever's left, they could quite possibly go after personal resources, i.e. your residence, retirement. I mean, it opens up the door. So I would just say, given you're dealing with a federal illegal substance, this is no joke, you want to make sure you're protecting yourself from a risk management perspective. That's one thing we do. We take a big risk management approach to relaying the facts. Everything in business is about enterprise risk management. So a C Corp, again, a flow through, I wouldn't recommend it. I know people who have done it, and I know people who did it and got out of the game quickly, and it was very beneficial to them. Again, I would just say, just know the risks, right? And if you're willing to accept that risk, that's up to you. Everyone's going to be different. Everyone has a different risk tolerance. Just to me, with everything going on in this industry, I personally wouldn't gamble with my children's college fund or my personal residence. It's not worth it.
Just to clarify, Kevin, which one was the flow through? The C Corp is more protected.
S Corps are flow through entities.
Got it.
And depending, like that previous slide, An S corp or C corporation has now a flat tax rate of 21%, which it's not as horrific as what it used to be. But the top um, tax bracket for some individuals could be 37%. So even now, corporations can be a more beneficial tax vessel as well.
Cool. And changing that over, that is possible to do midstream. So if someone's watching this and they're like, "Oh shoot, I'm an S corp." Is it just a matter of calling your lawyer and your accountant and getting the paperwork filed?
You have to do a file with the, yeah, I mean, that an attorney and a filing thing. I mean, I think normally you apply for a corporation and then you elect for S Corp status. So again, talk with your accountant and attorney that you want to be a C Corp. Or it might be that, you know, it's hard because you can't always license it or tied to the entity. So it's not like you can dissolve and reopen. So
Got it.
definitely talk with your professionals about it if that's something you want. Again, I don't mean to scare you. I just want to point out the harsh realities of the nature of this industry. And now that the IRS has collected enough information, as you can see from that Treasury report, they're going to start doing something about that. Now, I think they have their hands full right now with everything going on in the world. I don't think anything's happening this year and most likely not next year. But if the economy is hurting and the government needs money, that's some low-hanging fruit right there. I see another question here that's about, you know, kind of a split business. I don't know, maybe it's okay for me to, was this a public question? Is it okay to answer? Or read it out
I
loud?
think that's, yeah, I think you can read it. You can read it out loud.
So it
Yeah.
says, does it help if you can run another business through your farm? We grow cannabis and raise fish. Currently, I expense rent and other costs through the fish farm. What do you think? Well, this is, and in Harborside and in the other court cases, people were doing that. I mean, they're two very different business units. And if you're commingling stuff, the last thing you want is them to then say, you've commingled, you don't have anything. Both businesses are subject to 280E. And that's what happened in one of the court cases is that the management company was subject to 280E. So in that particular case, I would basically know, I would bifurcate the spaces, right? This is the space for the fish farm. This is the space designated for cannabis. You treat them as separate businesses. You do not want to commingle those two separate businesses. Now you want to have allocations, right? So you need to know based on your land and your space, how much you can allocate towards the fish, how much you can allocate towards the cannabis. But it's very important to not commingle the accounting between the two. And if you're aggressively saying, well, I take all my rent for the fish farm, why? Well, because I can deduct it over there. I can't deduct it over here. You know, that's not going to stand. Now, because you are a producer, you're growing cannabis, that it doesn't really matter because your rent, you can justify that, you know, the bulk of your rent on your entire property is associated to production, right? If you're retail, that's a different story. But because you're a producer, your rent would be deductible, a deductible expense. But the last thing you want is certain expenses that would not be deductible, i.e. your staff, right? You have people that are probably working both. That's why I'm like, you need time studies, you need job descriptions. If you hire someone, the job description, I would say this person's going to spend 50% of their time working with the fish, 50% of their time over there. Although it's always better to have separate people, but in reality, a lot of times you might have shared resources. Time studies are incredibly important. When you do a time study, you document when it occurred, what was the period it covered, and how much of their time was spent here and there. I know it seems unnecessary and a waste of time and energy, but that's going to be your only saving grace in an investigation, to have those time studies when they happen, documenting those to justify those positions. So again, I would separate everything possible.
And Kevin, that goes back to like what you're saying about that, documenting your processes. Like that is what you're going to use in court if there's a question. And am I right that this is like, it's just having things written down, it's having reports and studies?
Yeah, I mean, the processes are slightly different than the support. The processes would basically say, like, my process is to have a time study done, and this is how the time study would happen. This is how time study occurs. Yeah. Now, here's my time study, right? And it's important to, like, I talk with a lot of people, and they're like, oh, we have SOPs. What does that look like? and they'll pull it out and they're like, well, this has changed since then. You're going to be in a whole heap of trouble. If you have out of date processes that you're not on top of and monitoring, like your processes need to be a part of your life. So I don't believe in having documented SOPs that everyone's like, oh, they're filed away all neatly and we got them over there. That's great. You need to have a process focus throughout your operations. Processes need to become part of your operations. And that one of the tools we leverage is a dynamic process mapping tool that we'll use in consulting engagements, where we can map a process, we quantify all the steps in that process. So I can say, this process to perform cost you X. Now, if you change that process, we can plug it in. Now this process cost you Y. So you can actually see the evolution of your processes and the cost savings. Those are wise tools to invest your capital in, opposed to how do we circumvent these rules, right? So you want to invest in tools that'll take you somewhere rather than I just want to sidestep a rule. So be very strategic in how you operate in this industry.
Sure.
And then I think that was only part of my rent. Only part of my rent. I am very organized. Perfect. So as long as you're organized and you have those two farms, I would just say treat them separate. Anytime you have employees or things crossing between the fish farm and the cannabis farm, have support in some way, shape, or form. If it's an employee, it's a time study. If it's utilities, you're using like the land layout, things like that. And then accounting system you recommend, currently using QuickBooks. It depends. I mean, there's some very expensive systems that are very good. A lot of them have, no systems are perfect right now, right? We're chasing unicorns. The industry's still very young. I've seen systems come on and they have their quirks. It depends what you need. If you're the person that asked that, that's using QuickBooks, or you're also the producer. So you have an outdoor farm. There's like, Odoo is an open source one. There's LeafLogic. There's Viridian Science. We can talk offline and I can get an understanding of your particular case and I can offer up some solutions that I would recommend you demo. But LeafLogic would be one that I would definitely look at for your. Now, a lot of these, like LeafLogic, it's cool. They have modules like for cultivation, manufacturing. They also help with the cost accounting movement. Granted, you're going to pay more. Like Viridian Science does a great job of that, but you're going to pay a lot more. So again, you have to assess stuff and look at what's my cost benefit analysis. I'd say if you're spending tremendous amount of time around the cost accounting, having a more sophisticated software will help. And it's good to just look at it and say, all right, if we're going to go through an overhaul, let's do this wisely. And that's one thing we help with. We do help facilitate that. Like we help facilitate technology assessments to come up with what are your particular needs. We're going through right now and doing stuff where it's like we'll interview people within there to understand the different departments, what their needs are, what the shortcomings are, look to the market to come up with solutions, provide those solutions. Here's the pros and cons of each, what you can do. And I'd say the perfect time to start mapping processes is when you're implementing something big and new like that, right? Because you're going through all the process of implementing a new tool. It's best to kind of map all those processes in terms of how to use those tools at that time.
Marianne has a question here. She says, are there common mistakes you see on the producer side, i.e. miscategorization of expenses or other?
Yeah, I mean, I think 280 it's a terrible thing for the cannabis industry, right? Cannabis to me should not be scheduled as a Schedule I substance. So to me, it's everyone just being very creative and aggressive, really reaching. I've had people like, well, accounting, right? My accountant's spending time doing cost accounting, therefore that should be cost of goods sold. But the rules are, it's like that has nothing to do with the actual production, right? That's just what you have to do to track it, but it's not the production. So the most common mistakes I'm seeing is people being overly aggressive in terms of moving it. And as we went through the Treasury report, like for example, in California, of the $16 million of tax assessment, 15 million of that was related to people aggressively calling things cost of goods sold that weren't. So that's one of the big things. The other thing I'm seeing that most producers trip on is the fact that most of them can't tell me what it actually costs them to produce a pound of, that Gorilla Glue number 4, or whatever it is they're growing. Most of them can't tell me that because cost accounting can be challenging. If you're an outdoor grow, it's a little easier. If you're indoor and you have multiple rooms and you're doing multiple harvests a year, it can make it really challenging unless you have a sophisticated system to truly say, well, how much soil went in that room? How many people spent their time in that room? Nowadays, there's some systems and technology with scan capabilities. So when employees going in, they scan their card, they're in that room a half an hour, they come out, boom, your accounting system says that employee at this rate spent a half an hour in there. You're moving soil or nutrients in there. You're scanning and moving him into that room. The more sophisticated you are, the better you are. The big boys in this industry, they're doing all that, right? They've had a head start because 280E, they're like, it sucks, but they're raising a ton of money. They're banking on the fact they're gambling. They're hoping that they're hoping. And you can see some of the big ones falling out. They ran out of money before they thought 280E was going to be lifted. But the big boys are hoping that they can dial in a lot of this stuff and that rule will be lifted. And they're going to be sitting pretty because they've dialed in the technology to make their operations much more efficient than yours. And so the thing that this industry will be now, it's hard to have that really good craft because there, a lot goes into the curing and the pruning at the end, that a lot of those very massive facilities, even if they can grow very amazing product, will have a hard time to compete with someone putting into love into that smaller craft operation. But those big boys will acquire a lot of smaller operations in the near future. And then others will just get cannibalized, right? They won't be able to price their products accordingly or be in the stores. So you'll be under an umbrella of a bigger boy, but you got to have your accounting in order and have audits so that they feel comfortable acquiring your business. And so did that help answer that, do you think?
I think so. And the last question up here, and I think we might have time for one more if someone else has a question they want to throw in the Q&A box. Oh, actually, I think we got it. Yeah, Susie's wondering the name of the dynamic processing mapping tool you use. Oh, and then same thing. Does your firm offer business valuation services? It's a two-parter.
We don't. And so for the valuations, we don't. And the reason is I don't believe anyone can truly value a business in this industry, because a lot of what goes into a value is truly understanding the market. And since a material component of the market is in the illicit arena, I don't think it's really possible. You can use some cash forecasting projections, but again, your accounting has to be meticulous for that to even happen. So it's very challenging. And really, what is the value? It's what someone willing to pay. And a lot of people got duped by some very bullshit valuations that, early people knew what they were doing. They created this hype in these businesses, these false valuations. They made money and they're already out of the game. And that's sad, because this is an industry I'm passionate about. Most of you are probably passionate about. And it's a shame when people come in that have no business being in this industry and take advantage of it and then bail and then give the industry an even more bad name, right? It's already illegal. We have to deal with that. And then when you have people coming in and doing that, it's making it worse. So the first part, we don't do that. The process mapping tool we use, and it's an expensive one, but it gets an investment. It's under Nintex. It was ProMap. Nintex acquired it. What's amazing with that tool is that it'll help you just drill down and dial in your processes, allow you to evolve your processes. And then they have an automation platform and tool for that. So you can then not only, and that's why I believe processes are king, right? You start by laying out what is right now. Now you look, and this is all the lean protocol, right? And manufacturers have to be on top of this. Producers do. Once you have your process in, now how do you make those processes more efficient and how do they evolve? Why I love that tool is because you can assign costs and values every step of the way, so that you are actually, when your process evolves, you can now look and quantify it, right? I saved X every time this process occurred. The other cool thing with that tool is you can embed support and documents into it. So this tool is, it's ultimately an organizational tool that it's going to be the way your organization operates. You're going to live and breathe in this tool. And so let's just say, for example, HR, you can embed all the onboarding protocol. If you're inventory costing, here's all of our supporting documents. They're all in there. So if you have a new inventory manager, they can ultimately just follow your processes, have all of the documents and tools, everything you need in there. Here's our SOP on inventory. Here's our valuation methodology that ties into everything, into our chart of accounts. What we're trying to do is help clients create that web of processes to tie everything together to build a solid foundation of internal control. the more you have that stuff, because really what's the future is forecasting. And until you have all of that, what you need to be able to do is, before I change a process, let's say I'm going to pivot and do this. What does that look like? A good forecasting model. And if you have that information, you'll be able to see the outcome before you make it. And so that way you can then make decisions based on good information so that you know before you make a business decision what to do.
That's awesome. Thank you so much, Kevin.
Yeah.
If you don't mind, would you go on the panelist screen on my name, and under, there's a drop down there, you can make me the host again. If you don't mind giving me control.
You have it.
Awesome, thanks. Well,
yeah, I'm trying to give it. So under panelists, I click on panelists. Are you sure? I'm sorry. I haven't
there's my name and like a blue drop down that says.
Gotcha. I clicked on you. Now more make host. You have
there you go. Awesome. Thank you. Well, I feel like we should all do like a virtual round of applause for you. I am so, again, just thankful for you coming and sharing your knowledge. And it is clear that you know what you do, and you also have a true love and passion for the industry. And that is really what we need right now. I should say that Akina Consulting, not only are they members of the OCA, Kevin and I chatted a while back now, and they are now Leadership Circle members. So they've really invested in the OCA's mission and what we do, and they're here to help grow the industry in Oregon. And I'm very thankful for that.
Thank you.
For this information here, if you RSVP'd through Eventbrite, we have your email. And we will be sending out both Kevin's info, the slides, and then also this has been recorded and will go up on our YouTube channel tomorrow. So tomorrow I'll send you all those links. If you want something completely different but still a way to connect with the industry, we have another virtual smoke sesh coming up this weekend, Saturday at 10. We probably won't talk about taxes at all. Our board member, Oscar Nelson from Sweet Relief, is going to be hosting that and talking about some of his favorite strains. And we're going to be joined by Trista from Empower. Very different vibe, but again, just this kind of hope of bringing people together when we can't physically be in one space. So I'll send out an invite to that as well. Again, big thanks to Kevin. If y'all have any questions, you probably have the OCA email, but it's just info@OregonCannabisAssociation.org. And I think that's it. Thanks again, Kevin. Thank y'all.
Thank you. And all I'm here as a resource. Feel free to reach out. I, again, love this industry. I'm here to help. I want to give you guys advice. I want to help your business thrive.
Fantastic. Excellent. Everyone be well. We will see you again, probably virtually before in person, but we'll definitely see y'all soon. Take care.